What's an appropriate way to measure the investment performance of a fund and a fund manager? We're going to talk about it with a very special guest today on Open Interest. Hello, everybody. I should wait for the bell. You can't trade before the bell. Hello, everybody, and welcome. I'm Mike Khouw. Welcome to Office Hours. I'm joined, as always, by my good friend and co-host, Professor Mark Guthner of Rutgers, and also the special guest that I just referenced, Jeffrey Ptak of Morningstar Research Services. Jeffrey, welcome.
Oh, thanks so much for having me. It's a pleasure to be here.
I'd like to call you Jeff, actually. I think that's what you usually go.
Yeah,
Jeffrey,
Jeff, whatever's easier.
Okay. Better that. And I'm Mike, not Michael. So before we get started, I just wanted to touch on something really quickly because we are going to be doing something on Office Hours probably that we don't do as much, which is show a lot of very specific securities. I am not a securities dealer, so just a quick disclaimer. Regardless of what impression I may give, or Jeff may give, or Mark may give about any of the securities that we're going to be discussing, these are not a solicitation to buy or sell said securities. And we may have very different views on all of those results, but I just wanted to sort of get that out of the way. One other quick thing, a shameless plug I'm going to offer here. Of course, like, subscribe, and all that kind of good stuff. Put your questions and comments into the chat. But in addition to all of that, I just wanted to remind everybody that Mark has a book out. It was published by McGraw-Hill, Quantitative Analytics and Debt Valuation and Management. Very interesting text that I encourage people to take a look at, particularly if they're interested in doing things like hedging debt with equity. He works on some of the concepts that were built by Robert Merton, except that he does not use constant volatility assumptions in that text, so it's kind of an interesting read. And then, of course, the book that he and I co-authored, The Options Edge, which was published by Wiley in 2016. We will, at some point, put links to those in the description of this video. So just to get started, Jeff, since you're new to this, could you introduce yourself? And I imagine anybody who's watching this is familiar with Morningstar. They should be. But if they're not, maybe you could give them a little background.
Absolutely happy to. So my name is Jeff Ptak. I'm a managing director in Morningstar Research Services, which you can think of as the research arm of Morningstar. Morningstar has been in business since 1984. They started off as a data provider principally, and they've since expanded into different directions, analytics, software, research, as I mentioned, as well as various other services that they offer, including investment management, credit rating, indexes, and the like. But kind of our core sort of animating mission is to empower investor success. And so a lot of the research analysis that we do, is really sort of geared towards trying to help investors to achieve a better outcome in the future, or at least yield some insights that might put them in a position to succeed in the future.
So I guess the thing that probably, would you agree, that Morningstar is best known for are your fund ratings and rankings. So, Morningstar evaluates mutual funds, you evaluate ETFs, you actually do, I believe, some research and analysis on even single stocks and things like that, so that people can sort of get a sense of how a systematic approach to performance analysis might be deployed for the individual investor. Is that a way to think about it?
It is. Yeah, you got it. So I think it's fairly common for investors and others in the general public to associate us with those ratings that you mentioned. We put out star ratings on both managed investments and individual stocks, as you point out, as well as other types of ratings that might be forward-looking or focus on other dimensions of success, like sustainable investing. So yes, I think to many investors and others, we're the ratings people.
Okay. So, what prompted this whole conversation is that among the many things that you're taking a look at, you've been doing some analysis of some of the new sort of alternative ETFs that have been coming out lately. And I started working actually with one of the companies that, I don't know if I'll call it a target, but some of the articles that you've written might not be characterized as the most flattering, shall we say, about some of these. and we're talking specifically about YieldMax. And I happened to see the article that you published last week. You and I had the opportunity to speak at some length, I think, ahead of time before that article came out. And I thought we might go over that. I had that article up somewhere, so I wanted to show that to people if I can. See if I can quickly find it. And I have so many screens open. This one, I think, was entitled, "An ETF Gained 42%. So let's see if we can see this on my screen. I don't know whether people can see this, and I apologize if it's not that easy to see. I'm going to blow it up a little bit here. An ETF gained almost 42% a year. Its investors still lost money. Say hello to the YieldMax ETFs. So this was actually, I think, what kind of prompted this. And I thought we might want to dig into this a little bit. There's a couple concepts here, and I want to say from the outset that Jeff has done a lot of work in this space. You've written quite extensively, not just on the Morningstar website, but also on Substack. What's the name of your Substack?
Yeah, it's kind of you to mention that. Yeah, it's called Basis Pointing.
Oh,
yeah.
Okay. I haven't heard of that one.
Yeah. Oh, you have?
No,
you've read it, Mark?
I have not heard of it, so I'm going to go look it up.
Okay. Now, there's a couple concepts that this article gets into that I think are probably, well, there's probably a good number of viewers that might not be entirely familiar with these. Number one, these concepts, and number two, their application to, the ETF that we're going to talk about here, which is one of the YieldMax ETFs. I should also just quickly offer this because of my affiliation with YieldMax. YieldMax has, I think at the moment, 55 different ETFs, options-based, actively managed. And these ETFs fall into several broad categories. And I should point that out because I just want to make sure that in the context of this conversation, we don't sort of throw them all together because they're quite different animals. Probably the ones that YieldMax is best known for are the single stock covered call ETFs. So several years ago, and obviously this is long before I ever became affiliated with them, the idea was that there are folks who like to do covered calls. Covered calls are logistically sometimes challenging to manage, especially if you're using shorter dated options like weeklies or monthlies, because options expire, so you have to adjust your positions, or the stock moves, so you have to roll your positions, or some combination of these. So the logic for the single stock ETFs was that rather than self-directed investors buying the stock and selling covered calls and trying to manage those day to day, that they could buy an ETF that would effectively do that for them for a fee. Most of the single stock covered call ETFs are long the underlying, but not all. So some of them take short positions and sometimes in the same stock. So for example, you can buy a Tesla covered call ETF called Tesla, TSLY, or you can buy one that has a bearish tilt on Tesla, ticker CRSH, crash. So you can buy one that is long Bitcoin, you can buy one that is fiat. There's one in, maybe the best known of the single stock covered call ETFs is MSTY, MSTY, and the bearish variant of that is Winter, WNTR. So the logic here is that investors may be bullish or bearish a stock. They might want to sell options against that thesis. So that's one sleeve, if you will, of the YieldMax products. There are others. There's more diversified offerings. Ulti, for example, it has a number of different stocks. I can actually, since it's better to be precise rather than just go by memory, I can pull this up on my screen. That has these stocks in it: Robinhood, Palantir, CoreWeave, NewScale, a bunch of these. And it is looking to collect premium, but it uses a collar on those stocks, so it has a downside hedge in the form of a long put. There is an ETF that actually just buys all of the single stock covered calls in some measure called YieldMax. And then there's something called the Target 12s. The Target 12 funds are designed to provide, more modest distributions, but sort of offer, number one, diversification, and number two, some stability over time, and so on. But for our purposes, I think it's important that we can pull up one of those examples if we wish, but we're going to be talking principally about the one that you used as an example, and then we're just going to talk about this space in general. One of the things that Jeff uses is something called dollar-weighted returns. This is dollar-weighted returns, and since we have the professor with us, Mark, perhaps you could outline dollar-weighted returns, compare those to time-weighted returns, and what they are used for. I want to add, by the way, that this is something that Morningstar has been doing, for about 20 years or so, Jeff?
Right.
The general sense, my general takeaway is that dollar-weighted returns are a way to sort of think about an investor's performance, and time-weighted returns are a way to think about a fund manager's performance. Mark, maybe you could just talk about how you teach this in your finance classes.
Yeah, well, I cover three different ways to calculate returns. One is the simple return. You look at the change in time, throw in the dividends, and you get a return, and then you average those in a simple average through time. That's a simple average. One way to think about that is if you constantly have $1 to invest, and it goes up or down, and you go back to $1 for the next period and the next period and the next period. So that's simple average. And then there's geometric or time-weighted. I don't really call it time-weighted. I talk about geometric, and that does something similar, but it captures compounding. And so it's actually what you really earn in a buy and hold situation. And it reveals that real problem that investors need to be cognizant of, is that if you have a 50% loss in one return, so you start with $1, you lose half your money, so now you're down to 50 cents. You need 100% return in the following period just to break even. So it tells you start with some amount and then you end with some amount. And so what is the average compound rate of return over that time period? And that's the geometric. And then if you have, let's say you're an active trader in a mutual fund or a pension fund or something like that, but money is going in and out of the fund all the time. So you start with $1, maybe the fund goes up or down, but you add some more money to it. And then you have another period where the fund goes up or down. Then you add more money to it. And then the third period, you take some money out. What it does is it gives you an average rate of return over time weighted by the dollars that you have invested. And so I think of that last one as like what the investors would actually earn if they were actively putting money in and out of their mutual fund through time, and also, let's say they're paying some bills. They got some extra money in some months, so they put money in. Then they've got some bigger bills in future months, so they have to take money out. And then 10 years later, what did their average return look like? Then that represents the dollar weighted, and I think of that as the internal rate of return of all of those cash flows. Those are the three. Those are the three methods that I tell kids. The industry uses, and I like using the geometric weight of return when I evaluate what a manager is doing, and I like using the IRR method, or the dollar weighted version, for, like, let's say, an active investor who's putting money in and out of their account over time.
Yeah, I was going to say, you were talking about people buying and selling securities because maybe they have a little extra cash, or maybe they're paying some bills. I would offer that my guess is that a lot of trading activity by retail investors isn't necessarily dependent on household cash flow requirements, but probably people speculating, right,
Yeah.
in the markets, betting, oh, I think markets are going to go higher or markets are going to go lower. And I think, Jeff, isn't it accurate to say that Morningstar, kind of as a public service announcement of sorts, has really tried over the years to emphasize that investors have a habit, or I don't know if it's a habit, but it's your experience evaluating this, that investors aren't really doing themselves a whole lot of favors by trading. Whether they're trading stocks or trading funds, they tend to underperform. Isn't that true?
You got it. Yeah, very well said. So they do have a propensity to engage in, call it chasing behaviors. So when we talk about chasing, it might be a return that they're chasing. A fund has an enviable return, and so investors respond to that by, shoveling money into that fund, and it with the benefit of hindsight prove to have been in an opportune time to be adding money to that fund. Why is that? Because performance subsequently moderates. It gets worse. And so the return of their average dollar in that fund suffers for that reason. So the fund has a return of X, and maybe the investor, their average dollar has a return of X minus some amount, that difference owing to the timing of their purchase in that very simplistic example that I gave. So, and we've been doing...
Well, this is true. I mean, we're talking at this point about just securities in general. This is
right.
kind of, I think it actually goes beyond funds or mutual funds. Probably this doesn't happen as much because it's not as easy to buy and sell them. Hedge funds and private equity funds are almost impossible to time because you may not necessarily invest or redeem at will the way you can with a tradable security like a stock. And I assume that most academic studies, Mark, they have found that this is generally the case, that investors' trading activity rarely works in their favor. I doubt, for example, those that trade NVIDIA have outperformed a long-term buy and hold in NVIDIA. Would that be a safe assumption?
Yeah, Fidelity did a very interesting study, and it looked to see what the performance of their dormant accounts was. Let's say somebody passed away and the heirs didn't know money was there. So years go by and they see how the funds did or how that accounts did over time. And they found that was some of their highest performing clients, which is kind of crazy. But that was one of their findings.
So this sounds like we're reiterating a lesson that Charlie Munger and Warren Buffett have said, that Jack Bogle have said, that countless academics have said. Buy and hold. If you're an investor, buy and hold. Pick something that you like, buy and hold it, don't trade it. Are we all kind of on the same page with this one?
I think that's good counsel. Yeah, and that's corroborated by research that we've done as part of the Mind the Gap study that I mentioned earlier. As it happens, the investors that earn the largest share of their fund's total returns, they tended to invest in what we refer to as allocation funds. So probably the most popular example of which are target date funds.
Oh.
And what can we say about target date funds? They automate a lot of the investing experience. You don't need to buy and sell in the way you might, or maintain the way you might another type of standalone vehicle. And so that automation works to the investor's benefit, we have found in the study. So I think it very much buttresses the point that you're making, Mike.
All right. So I think we probably want to start getting into some of the more specifics that are related to some of these options-based ETFs. But can we then basically establish that if we're trying to evaluate the quality of a fund, of a strategy, and of the fund manager, for our purposes, we should be focusing on total returns over a period, over periods, looking at returns and versus volatility, rather than taking a look at what traders, whom we've just established are not particularly good at timing stocks, are doing. Does that seem fair?
I think we would agree that if you were trying to gauge the effectiveness of the investment strategy, then yes, you would want to look at the total return. So the total return for, your viewers, that's going to be the returns that, are shown on the website and the regulatory documents and other places like Morningstar.com. And so that's that time-weighted return, assuming an initial lump sum investment. I would say, though, we have found that, a fund company can have an influence on how successfully investors are using the products to capture as much of the total return as possible. And so, yes, if you want to look strictly how well are they executing the strategy, it's that total return. That being said, they can have some effect on how successful it is investors are in using those products and getting as much value out of them as they possibly can.
Yeah, I mean, Mark, I would assume that one of the reasons that individual securities, I'm going to assume, or individual investments, it's not just securities of any type, are their behavior, the behavior of those instruments, and how those results are reflected back to investors, probably have an impact on the behavioral psychology, right? So that is to say that if I have, it's one of the reasons I would say I have such an issue with private equity these days, because private equity has this remarkably steady appreciation that its publicly traded equivalents probably would not have, but they're very attractive investments for this reason. People would look at them and say, oh my goodness, this is just a straight line from the lower left to the upper right and very low volatility. And that's a good buy and hold investment. Whereas if I have something that behaves like Bitcoin is actually less. The volatility of Bitcoin has dropped considerably. But if you went back to it 10 years ago, the volatility was almost off the scale, and there was a lot of ebbs and flows in terms of investment because of the volatility. Isn't that right, Mark? You're big in the Bitcoin space. You even mine this stuff. So.
Yeah, that's how I heat my house. So. Jeff, I understand you're out by Chicago. I walked in late on the pre-talk.
You got it.
That's one way to heat your home. That's how I heat my home, is I have a number of quiet machines. They're sort of like hobbyist machines, yet they still, mine a couple $100 worth of Bitcoin every month, and it's enough to keep my modest place, because it's about 1,600 square feet warm. My wife thinks I'm nuts, but we don't have to run the heater in our home. And I'd say I teach digital assets here, and that's partially why I did all this, is because I better know how to do it myself if I'm going to do that. And we mine a bunch of things here at the school as well. But we got off track, and I'm sorry, Mike, I forgot the question.
It's all right. I think I was just basically making the point that I imagine that investors tend to react badly to assets that are more volatile. I think it's probably not a bad time for us to talk about the CONY ETF that you mentioned in your article, which was the example that you provide. And one of the other concepts that comes up here, which I think probably deserves some explanation, and maybe, Jeff, you can kind of explain what this is as you write about it in your article. And that is this concept of return of capital, return of investor capital, because you make a specific mention of it in here. Maybe we can find this section, and I can just share this on my screen. I believe I have to get to the case study section here. And so just as a reminder, I mentioned this at the very beginning. We're going to be talking right now about the YieldMax coin income strategy. What is that? It is a single stock covered call ETF that buys actually a proxy for coin, because the way ETF rules are written, concentration rules, because this all falls out of the 1940 Act. So there are concentration rules that are associated with that. You can't just buy $1 million worth of a stock, sell calls on that $1 million worth of stock, and then offer investors an opportunity to buy a fund that only does that. So that is not compliant with the 40 Act. However, you can create ETFs that have a portfolio of options, some of which behave like the underlying stock, so a synthetic equity position, sometimes called a combo, where the fund is long a call and short a put in that security, and then look to sell some options premium against it. And
I didn't know that.
now, if you do this, you're selling options. In theory, you're collecting some options premium. You're also going to be experiencing gains or losses associated with the behavior of the underlying stock. Now, this fund, CONY, makes regular distributions. So it makes a distribution every 4 weeks. And when that distribution comes out, it gets characterized as income or return of capital. Jeff, what is your understanding of, and how would you describe what return of capital is? Because in this, I think I have it on my screen. I don't know if I can blow this up because it's hard to read, I know. All right.
Yeah.
This says that 83 cents of every dollar the ETF distributed was return of capital. What is, for the investors watching who don't know, what is return of capital?
Yeah, so return of capital, sort of that specific reference, that comes from what Tidal, the manager of the ETF, had reported in its financial statements from its inception through April 30th of this year. And so when...
Oh, I thought that said... I'm sorry, I thought that said July. I think you said July in the article. So maybe you were looking at the 19A-1s. So it says data as of...
Yeah, so I might have taken it out to 731, but I know for certain that I was relying to a certain extent on, as you can see in the chart that you're showing right now, relying to a certain extent on what was filed in the financial statements. And so the financial statements will basically break out the components of a distribution, that which was from the earnings of the ETF and that which was from other sources. And so that return of capital, that's the plug. And so that's where those numbers were coming from, was from what Tidal itself had reported.
Okay. Well, we probably need to get into what is return of capital. I mean, it probably sounds intuitive to most people, but there's two concepts for return of capital. One is because there's different sort of regulatory oversight of this, but what is your understanding of what that return of capital is?
Yeah, so the way I've tended to think of it in fairly simple terms, it's that portion of a distribution which is not funded by underlying investment income and gains that are realized on the investments. Now, I know that it can have a particular meaning in sort of tax parlance, and maybe in some other contexts. But the reason why in the article that you're referencing, I focused as much as I did on what was reported by Tidal is because it made it pretty clear in a number of cases that the ETFs weren't generating, I should say, enough income and gains to fund the distributions they were making. And I think writ large, that's the reason why you see the rampant return of capital that you've seen in some of the ETFs in question, including the one that you're talking about, which is CONY.
All right. So I have on my screen here at the moment, I have the record of distributions of CONY since its inception. So I apologize for this because I realize this is probably almost impossible to read. So I'm going to try not to move things around too much because I think if I do, it's going to be harder for people to reference this. You said at the time that the article was published, which was on September 23rd, I think. Is that right? That you had only gone through April 30th. I thought it had gone through the end of July, but in any case, we can work through both examples. Your
reporting went through April 30th, and so I relied on that as much as I could. But for some of the other calculations, I took it through end of July, principally when I estimated the dollar-weighted returns of the ETFs.
So the return of capital from inception, the way you reported in the article through April 30th, being 83% return of capital, makes it sound as if somebody put $1 in, that 83% of the distributions that came back to them since they put that dollar in was just their own money coming back to them. Does that sound like a fair characterization of how that reads?
But that sounds like a fair characterization.
So I guess I would just have to ask you to help explain to me then the total distribution. So the fund started at $19.77 a share, and by the end of April of 2025, it had distributed $28.61 a share, nearly 145% of the initial investment. And of course, the fund was still around and has made considerable distributions since. 83% of that number, so if you're saying that 83% of those distributions were return of capital, that's 120% of the initial investment. So you put in 1977. By April 30th, you've received $28.61 back. Title said that 83% of that was return of capital, which is actually a characterization of a distribution used for tax purposes. It's not actually a strict definition of return of capital. How do you explain that an investor got more than their initial investment back in just over a year, but it's just their own money coming back to them?
I think it's mixing a few things. I think that when you're calculating your NAV, that's a time-weighted return calculation, if I'm not mistaken. And if you go to the financial highlights section.
Oh, this is not the NAV. These are the actual distributions. I'm saying if you bought a share, by April 30th, your distributions were $28.61 a share. So you bought it for $19.77. You did nothing. Okay? By April 30th, so that you bought it in October or whatever of 2023 or September of 2023. By April of 2025, you've already received $28.61 back. Not reinvesting. That's not NAV. That's just what you've received in distributions. Okay? There is also the NAV because you still hold the shares. That's 145% of your initial investment. 83%, you're saying, is return of capital. That's 120% of your initial investment. I'm just trying to understand how you can put $1 into something, get $1.45 back in just over a year, and you're saying that $1.20 of my initial dollar was just my own money coming back. Where did the extra money come from?
You're returning capital. It's in your own financial statements. You don't have the income and the gains to cover the distributions.
No, but how do you return more capital than there? How do you return more capital than was originally there?
Good question, Mike. So you have money that's continuing to come into this product, and so you're continuing to declare a distribution rate on an enlarged base of assets, and so you continue to put distributions out. So I think that sort of pattern can continue as long as you continue to get inflows to the product. I don't know that necessarily. I don't know that necessarily.
Are you suggesting this is some kind of a Ponzi scheme or a pyramid scheme? You're suggesting that these payments are coming out of somebody else's money?
Not at all. No, I think the accounting is fair. What I'm saying is, as you get additional inflows and you continue to declare distributions on those inflows, you're going to see a pattern of continued distributions, but that doesn't necessarily tell you that what's coming back to the investor is accruing to their benefit. And I think that's kind of the crux of the issue that I was trying to highlight in the piece, Yep, go ahead.
Yeah, I mean, I guess my point is that I still really am struggling. So the return of capital is a characterization of a distribution, right? So the important thing to think about here is if we take a look at the total returns for this fund since its inception through the present day, right? Maybe that will lend us some clue as to where the money is coming from, right? Would that be fair for us to do that? Just take a look at the performance to date. Is that all right?
Well,
and the distributions.
Sure. So
this is Bloomberg.
Yeah. So the performance to date is going to be a time-weighted return. So
yeah,
and we're talking about.
So this is how much somebody who put $1 in the beginning would have now. Is that right?
That's right. But when we're talking about dollar-weighted returns, it's taking into account the timing.
We're not talking about dollar-weighted returns, though, because you're talking about people who bought and sold their individual experience. We're talking about the performance of the fund and the distributions that somebody who put $1 into that fund would have received. And what I'm saying is that and this is, it's not me saying it, this is just a fact, $1 put in at the beginning here, if you reinvested the dividends, would have grown by 135%. Okay, so if you reinvested the dividends, right? If you put $1 in and you just kept the distributions that you got back, and you just put them into your checking account, risk-free rate, you have made 100% return over the period of time in question, right? Because all of these distributions plus the residual value of the shares. So I bought the shares at 1977. They're now trading at 680, and I have taken, in that time, I have managed to collect a grand total of $31.48 in distributions. That's the experience of the investor, right? So the amount of distributions I've received is 160% of my initial investment. That's the distributions, and I still hold the shares. So I keep coming back to this thing that I think your understanding of the return of capital characterization might be a little bit off. May I provide an example of how something like this might work in practice?
Sure. I welcome that.
Fund is trading?
Go for it.
Okay. If a fund is doing a buy right, and I own the underlying shares, so let's say the shares are $100, and I sell the 100 strike call. So it's an at the money call option. I sell it for $2. All right, expires in 1 week. Now, at the end of the next week, the underlying shares are now $105. Okay? If I distribute 7, so I just take money and I hand it to investors, $7. 5 of that would be characterized as a return of capital because I had to buy my call back that I sold at 2 for 7. Right? So I actually have a loss. In this situation, I can characterize 5 of the dollars that I return to the investor as return of capital. But did I actually return their capital and did I actually lose any money? I bought the shares for 100. They're now trading 107. I sold the call for 2. I have to buy the call back for 7. So I lose 5 and I distribute 7. What's the net asset value of the fund? $5 of return of capital. You see what happened there?
No, it's a helpful example. I would just point out that CONY, the ETF that we seem to be talking about, at least as it relates to the article, it by your own accounting, it lost $36 million, from its inception through April 30th, which is the sort of the most recent reporting I have to go off of. So that's not my accounting. That's Title's accounting of how the dollars that were invested in that product, how they did. And so what it ultimately.
But Jeff, it seems to me like you're going back. You're trying to conflate two things, which is the performance of the fund and the fund manager. And by the way, I'm not sure that your math on that is quite right, to be honest. One of the reasons I have reason to doubt it is that when I was taking a look at this, and I'm not sure if it's in here. So we can show this chart. So what we're looking at here, these are fund flows, but the more important line I want everybody to sort of pay attention to is the orange one. So the orange one, this goes right through the present day. Now, if what you're saying is that for the period ended April 30th, that CONY did not perform well. So if you go from, say, November 1st of last year through April 30th of this year, that it didn't do particularly well, because that was the period that you were looking at. I think the answer to that is, well, that's true. The fund didn't do particularly well. I mean, if you had invested at the beginning of that reporting period, if you put $1 in, if you just took the cash distributions over that period of time, which was 6 months, 6 months ended April 30th. So you put $1 in at the beginning, and you just took the distributions, stuck them in your checking account, your total returns would be 15.93%, as this shows here. So you'd be up about 16% in 6 months, right? Which is not nearly what the performance of that fund has been in the period since. So one could say that if the fund's earlier success prompted people to buy at that moment, and that their performance then lagged what investors who had bought it earlier had experienced, I think that might be true. And the assets in the fund have been growing. But I wouldn't really be comfortable characterizing it in September that those people did poorly, because if you take a look at the fund flows, what you'll notice is that they've been rising quite consistently. And actually what's interesting is that the fund flows, the actual money flow into the ETF was positive in April of 2025. So the dollar-weighted returns since then are almost certainly going to be quite good. So first of all, we know that a total return is a better way to take a look at a fund's experience, because in the same way that if we want to look at the value of a strategy, you're going to think about how you would do as an investor. You want to see how the fund did, not how people who happen to be day trading the security did. But actually, even those folks didn't really appear to be doing much selling. And since that time, the total returns are 28% if you reinvested in the security, 27% if you didn't reinvest a single distribution. And if you take a look at the fiscal year to date, so that's just if you had put $1 in at the beginning of this fiscal year, your total returns, whether you reinvested in the security or you just kept it in cash, are about 34.5%. Isn't that right?
So going off of your numbers here, that sounds right.
Yeah. Well, these are Bloomberg's numbers, not mine.
Yep. And Bloomberg's numbers look correct.
Yeah. I mean, and since the article was written, and I understand you were trying to look at those financial statements, so you were basically trying to take a look at what traders were doing, not what the fund was doing. But when you wrote the article, that was the 23rd of September, it didn't seem like you had mentioned that the total return of the fund since the end of the reporting period was better than 25% if an investor had simply held on and just taken the distributions and done nothing.
But we did show in the piece the estimated dollar-weighted return and the ETF's total return from its inception through July 31st. So it wouldn't get you all the way into the present month, but it got you to July. And so the estimated dollar-weighted return, this is the estimated return of an average dollar invested in the ETF, was around 17% per year. The ETF's total return, which is the return that you would see on like Bloomberg you mentioned, our site, what have you, was around 43% per year. So what it meant is, by our estimates, they earned a positive return. And that's attributable to the fact that the average dollar got some lift after April 30th, which is as far as your reported information went. But it still was well shy of the ETF's total return. You know, we haven't really talked about why those gaps can open up, but that was what we had estimated when we looked at it through July 31st of this year.
So Morningstar, actually, when you're reporting a fund's results, you report the total returns.
That's right.
The time-weighted returns, because that is a better, fairer way to think about a fund manager's performance. Yes.
When you're trying to gauge the effectiveness of the strategy, how it's literally performed, assuming an initial lump sum investment, correct. I would point out that we do, for mutual funds, we do report dollar-weighted returns, but what you would be most familiar with seeing on our site, if you went to it, were the total returns. To your point, Mike.
Mm-hmm. So, I mean, I think we kind of we talked about this a little bit, but Mark, I mean, I've been doing a lot of talking and asking some questions. You're the co-host here. Do you have any questions that you?
I do have questions. One being, why is it that funds like to do a return of capital? I remember when I started in the business trading bonds for pension plans. And one of the things that was popular was, especially amongst some of these closed-end funds, was to pay out a return or pay out a cash flow higher than their IRRs or their average portfolio yield. So the yield to maturity on the portfolio, let's say, was 7, but they would pay out 10. I never understood why companies would want to do that, because it would be like slowly
Well,
liquidating your
I'll ask
fund.
Jeff this question.
And so,
Since
and so I don't
let me ask
understand
Jeff a question.
the whole thing.
Well, let me ask you a quick question of Jeff. So, assuming a distribution is characterized one way or another, so all else equal, so you have a fund here, it's distributed 160% of the initial investment as 83% return of capital. Now, by the way, I want to make this point for investors. You cannot, so when you get a return of capital, it lowers your basis in the shares. So if I bought the shares for 1977, the instant that I take 1977 in distributions back, regardless of how they are reported to me, I cannot report additional distributions thereafter as return of capital from my tax perspective, because you can't have a basis less than 0. So if you're reinvesting some of those distributions back into the ETF and keeping the basis up, then you can, keep bringing it down. But I guess the principal reason that return of capital is more attractive, all else equal, is because it's not immediately taxable in taxable accounts. So if a fund manager is trying to deliver the highest possible total returns net of taxes, then a return of capital is a good thing, right, Jeff? Because all else equal, if you get a distribution, so I have a pool of assets, there's some income in there, there's some capital gains in there, there's some dividends in there, and there's some capital in there, and the manager says, I'm going to write you a check from this. What is the best outcome for you from the way that gets characterized? You put 100 in, it's got 150 in it now. If they say, look, I'm going to return 50 of the initial 100 that you gave me as return of capital, that is almost always, can you come up with any example where it would be better that it would be characterized as income or something else?
I don't know why I would want my capital returned to me. I understand that maybe there's a certain tax imperative for that, but
no. But if they're giving it, if I'm going to give you a distribution, so and this happens, fund managers will say, "I'm returning capital to shareholders." Hedge fund managers do it. Renaissance did it, so on. So they said, we can't manage all of these assets, or we've made a mandate that we're going to distribute as much of it back to you in real time, so that it is up to you to decide what you're going to do with your money. If I give it to you, if I distribute that money to you, is there any reason why you would not want that characterized as a return of capital?
I suppose not, but I also would probably much rather a circumstance in which I'm investing for total return, and then if there's an income need, I can exercise control over the character of however it is I decide to generate the distribution.
But if I gave you the distribution as a return of capital so that there's no immediate tax consequence, you, at your option, may immediately redeploy it, right?
I can, yeah, but you're just giving me my money back. I understand your point, Mike, but I think in a more ideal circumstance, I think the capital wouldn't be returned to me and could be invested in a way that was reasonably tax efficient. I think the elephant.
Well, this is the most tax efficient way, because under registered investment company rules, right, you're required to distribute 90% of all income gains and so on. And otherwise, the fund is subject. So the fund is going to, whenever possible, put the money back. Now, the fund manager has a real incentive for you to give that money back, right, because that's how they get paid. Right? They're not getting, if they distribute your capital back, they're not getting paid to manage it anymore, right?
That's right. Yeah, I wouldn't think that you would want to return capital for that reason, which is a point I think that I've made to you in our correspondence previously.
Yeah, in fact, obviously, ideally, you'd rather keep it, but the reason you do that, right, as the manager, you'd rather keep it, but the reason you do that, if it's for tax efficiency purposes, what your hope is, look, I'm going to give you your money back. You can do with it whatever you want. We're still here. We're ready to accept it. So you could reinvest it. And the interesting thing is, if the money comes in and out, when the return of capital comes, it reduces your basis. When you put the money back in, it raises your basis. But otherwise, there is potentially the risk that the manager is going to be taxable. The fund itself is going to be taxable, which is bad for all the other investors. So return of capital is better for the fund and is better for the investor if the money comes back. And unfortunately, this is the inconvenience, right? That isn't it true that, fund managers really are challenged sometimes because you have to navigate the SEC rules, the RIC rules, and IRS rules, right? Sometimes the IRS always has their hand out. They always want it's the misfortune for investors that I think probably the biggest harm for all investors in terms of compounding, unless you're in a tax-free environment, is tax, right? That if corporations didn't have to pay income tax, if we didn't have to pay income tax, we didn't have capital gains tax, we'd all probably do a lot better as investors, no?
I take your point. And yes, managers have to fend with those rules, and there's certain intricacies that arise, and there can be an argument for returning capital, as you point out, in certain circumstances. But as I look at the situation, trying to step back, I think probably the most logical explanation for why YieldMax ETFs are returning so much capital is there just isn't enough underlying earnings power. They're not, the investments aren't throwing off enough income or generating sufficient gains to fund the distributions that you're declaring. And so I think this has given rise to shortfalls, which are plugged by return of capital. I take your point, Mike, that there are some nuances when it comes to characterizing distributions as from distributable earnings versus return of capital. There can also be a tax motivation for it. But the elephant in the room is when I've kind of gone through, with the exception of the MicroStrategy, YieldMax MSTR, I think the other ETFs I looked at were aggregate money losers based on your own reporting through April 30th. So really, as in sort of my very simplistic way of looking at it, that's kind of what it comes down to.
You mentioned MSTY, and I think that's fair. And of course, for anybody who's been following strategy and Bitcoin, frankly, strategy has not been doing particularly well of late as a stock. I'm sure Winter, which is YieldMax runs a bearish strategy on. It runs a bearish strategy on strategy, as it's now known. I'll call it MicroStrategy for our purposes, because otherwise we're going to conflate investment strategies with the company. But so this is MSTY since inception in February of 2024, and as we can see here, it has total returns, dollar invested total returns in MSTY since inception. If you'd reinvested, which is kind of what we've been talking about, so if you took your distributions and you plowed them back in, you said you like the compounding effect, and you would have in MSTY's case, because your total returns in about a year and a half would be 232%. But if you had not reinvested your dividends in MSTY, the total returns, at least by Bloomberg's numbers as of today, would be about 175%. But I think more to the point, you would have gotten more than 200% of your initial investment back in distributions by now in 18 months. In fact, actually, we can probably figure this out. We'd be able to see, if you put your money in, how fast you got your money back. And Mark, let me ask you, from an investor's perspective, you were talking about IRR before. When people make investments, isn't it generally favorable to buy an investment that, assuming it doesn't have a tax implication, which it almost always does, but in an ideal world, if you could make an investment and you didn't have to think about tax, wouldn't it normally be better if it made regular distributions to you? So, I mean, is a bond that pays regular coupons, all else equal, more appealing than a zero?
Well, it depends upon what your investment objective is. If I have a child who's just born, and
you have a young child,
and then I wanted to put some money away for college, I go buy an 18 or 20-year zero coupon bond. I know exactly how much money I'm going to have
no reinvestment risk
in the future. Yeah, so because there's no reinvestment risk, so I could buy a 20-year government bond. And then the government or the Fed drives interest rates down to zero. And so my reinvestment on all those coupons is a donut. I would end up with much less money. It depends upon your objective and your risk tolerance. I think if you thought rates were going to go higher, then you would probably prefer a coupon bond, because then you would be wagering that you would be reinvesting your coupons at a higher rate. It just depends upon what you're trying to do. I don't know if you could throw up on that chart below you. How did MicroStrategy stock do all by itself? So you just buy it because
well, MicroStrategy has not been doing particularly
well over that same time period.
Well,
that was saying there was up 270%.
Yeah, actually, you know what? Let's do this. Let's do this. Oh, you know what we should do? What we can do is we can probably do
because that's the way I look at this is if I'm buying a stock and I'm selling a call against it, I have a little less risk than owning the stock outright. Not a lot, but a little less risk. And the question is am I better off doing this buy right strategy or just buying the stock outright and forgetting about all the trading activity?
Well, someone who's buying the ETF doesn't have any trading activity, right? That was, I guess, the whole utility.
You
right?
are going to have somebody's doing the work for you, but there's a transaction cost that you're incurring.
Yep. Oh, this has got the wrong thing in it. Hang on one second.
So I just wondered if you would have been better off just buying the stock and forgetting it, or was there some value created by selling some options?
Okay, so this is the total returns for MSTY versus strategy.
MSTY is the white line.
Cumulative. This is not since inception. I'm sorry. This is it defaults to, what is this defaulting to? Why is it going back to November? So since November, which is, I know why it was back to November. This is because we were looking at this before. We were looking at the beginning of this fiscal year. But if you go all the way back to the beginning, and I'll bet you this is true for NVIDIA also, that if you were not looking for distributions, and I'm going to go...
Is this saying,
by the way, if you're looking,
kind of a wash?
Yeah, hang on.
Is that what that's saying?
I'm going to... Oops, hang on. No, they were not the same. If you were looking at stocks that had huge... appreciation, and you're not that you definitely want to be long the stock, not in a covered call.
Okay.
So if you could go back in time and say do covered calls on NVIDIA back 20 years versus just buying and holding NVIDIA, buy and hold NVIDIA would have been better than just about anything. Right?
Yeah, that's why
buying and holding Bitcoin would have been better. But I have a way to do the cumulative cap. Here we are. So for people who are wondering why I'm putting the year 1900 in as my start date, that's because I don't know when some of these products actually begin.
The year-end date.
But Bloomberg's clever enough. It usually figures it out, right? So it'll go, it's supposed to. When did MSTY get started?
Yeah, it was February 21st, 2024, I believe.
Okay.
Oh, nice memory.
Jeff has been studying this stuff. Longer than I have, just to be clear. Jeff was writing articles about why is it going back to November? I don't want that. 02. I'm just going to put you know what? It's possible that the inception date is not the first trading date, and Bloomberg, I've seen this before with ETFs, it doesn't like that. There you go.
Okay, so we've got the white line.
This is the, just so that everybody's clear, The white line is MSTY, and the orange line is MSTR. Strategy, now known as MicroStrategy. So you can see they basically tracked together. MSTY outperformed where it was green, and it underperformed where it is red. And then, basically it's sort of been tracking along with it. So when what happened last November? Was there something big that happened in November? I'll bet you anything. What happened was that strategy probably rocketed higher and probably blew through the short calls. You see this right here?
Yeah.
Jeff, you can see my screen too, right?
Yes, I can.
Yeah. So basically, I think what's going on here is that if you're in a covered call is kind of like selling puts. So it's a bit like if you're selling insurance on stocks. In fact, that's, I think, not a bad way to think about it. You're looking to collect premiums all the time. And of course, you care that the value of the underlying asset holds up. That has important implications. If you don't think a stock is going to do well, don't do a covered call on that stock, I think is a simple rule we would all agree with. But if you think that a stock is going to rocket higher, then you probably don't want to sell calls on it. And now I'm going to take a quick peek, and we're going to see what happened to MicroStrategy last November.
I think the stock doubled really quick, if I remember right.
Here we are. Oh, there you go.
Yeah.
Well done, Mark. There you. Yeah. See, you're a smart guy, professor. That's how that happens.
Well, I was trading the options and the stock back then, so.
It more than doubled. Look at this. Between September 6th, so post Labor Day low, was $114 a share, and it rocketed. Look at that. It went up to $476 at the mid-November high. And that's because, folks, MicroStrategy it was a more levered play on Bitcoin. 314%.
Yeah.
314% in just 53 days. Wow. That is really something. Now, one of the things I want to also say, because we're coming up on an hour here, and I've really, Jeff, first of all, I want to thank you for joining us.
Oh, thank you. I appreciate having the opportunity.
A real pleasure to have you on. And the other thing is that one of the challenges in an environment like this, you got two hosts, one of whom you've only spoken to once before, me, one who you've never spoken to before, Mark, asking you questions about an article that you wrote, and just trying to understand it a little bit better. But I want to say that I think you're doing a lot of important work, and I don't think we touched on all the topics that I think I would like to. Number one, I'm very interested in the idea about these dollar-weighted returns and what fund managers can do to help encourage investors so that they understand what they're buying and what they're going to get out of it well enough that they get to take advantage of it and not, for lack of a better word, it's not fair to say do dumb stuff. It's not dumb for people to do things if they don't know what's going on, right? But they need to know what they're buying. You got to know what you're getting, when it's going to do well and when it's not. I think we should probably, if your time permits it, or if you do podcast yourself, have another conversation where we talk a little bit more about return of capital, because I think that the understanding that people have about this gets lost a little bit, because the return of capital, the way it gets characterized, it's a distribution characterization, and it's influenced by a lot of things associated with tax. But I will, I think we should probably get into that a little bit more. I'd like, Jeff, though, to let you, because you're a guest here, and I've been doing a lot of talking. I'd like you to just sort of weigh in, if you will, with whatever final thoughts you have, and hopefully you can come back and we can have another thoughtful conversation. And if you have some material or screens or
Yeah,
material that
no.
you'd like to share.
Hey, I'm happy to come back anytime. Just give me a holler, and we'll chat again. The overarching purpose of the research, which is of a piece with other research that we've done, is to try to derive a sense of how investors are faring, in this case, in a set of products that are yield oriented. And that's something that we've been pretty consistent in doing, looking at the various dimensions of success and, trying to share some information with readers that converge in our platform. So just in case people are sort of wondering kind of like, what does an article like this, where does it emanate from? That's really sort of the motivation for it, is to try to get a sense of how that average dollar has done, sort of in a dollar weighted sense. And hopefully, while we might not come to the same conclusions on some of the issues, people have found our different perspectives helpful. So I really appreciate you having me on.
I appreciate that. I would ask you one quick question, though, which is, based on what we just talked about today, would you agree that a dollar invested in one of these things probably did pretty well to date? I mean, even if I know that you're not crazy about the high rates of distribution, the return of capital thing is, let's treat that for what it is, just a characterization of a distribution. But I don't get the feeling you're that crazy about these products. Is that fair?
Fair. They're not my cup of tea. To be fair to you all, we could say that of 99.9% of what's available to me. I'm a bit of a prude when it comes to investing, and so these don't necessarily sort of fit with my needs. As far as your question, the stated returns, the total returns of these products, those are reported. They're on our website. People can take a look. Some of the products have done quite well in absolute terms. Like an example of that would be MSTY, though it's had some bobbles recently. Its since inception return in absolute terms is quite high, even if it isn't as high as MSTR's return over that same period of time. But it's going to vary product by product. And really, my purpose in doing the research here was to look at how that average dollar has done, which is a little bit different, as we've talked about, than that time-weighted return, which assumes an initial lump sum investment.
Well, I think all investors are glad that you're doing that research. I really look forward to having you back on to talk about this stuff in greater detail, and time permitting, we can kind of get a little thing together so we know what we'll be talking about ahead of time.
Sure. Sounds good.
Mark, I know you. Actually, you're not in your office, are you?
No, I am in my office. Yeah.
Oh, okay. So you haven't had any students come in and interrupt us today?
No, often they do, but not today. No popularity today.
I'm going to take it that you have not graded any exams harshly lately, which I would assume is going to increase the amount of foot traffic you get.
My first round of midterms is a week after next. So I teach 4 classes, and so I'll have 4 midterms. I give 2 midterms and a final quiz is my style. Instead of a midterm and a ball busting final, I do 2 tough midterms and sort of, a relief final. And I find that students like that style a little bit better because they have 4 or 5 finals to take, and then mine, they don't have to do quite as much work for my class for their final.
All right. So final thing for everybody, like, comment, subscribe. Questions in the chat, please. Follow Jeff Ptak on his Substack, Basis Pointing. You can see what's going on over there at Morningstar. There is a big team. They've been doing a lot of important work for quite a long time. And I hope you guys will tune in for office hours again next week. Jeff, I can't wait to have you back and get into this stuff or other topics a little bit more. And maybe you'll want to do this because it's going to get cold pretty soon in Chicago. So hanging out indoors and getting in front of a camera is probably more appealing than going out and getting on a tennis court or something like that.
Sounds good.
All right.
Thank you.
Thanks very much. And thank all of you who tuned in. Thanks very much for watching it. We'll see you next week.